Welcome to this class on risk analysis. This is the first of two classes that we live on risk analysis. The idea behind these classes is that investors do not like risk, so they prefer to avoid or control risk if present. And so they want to quantify the risk to isolate the risk factors from a qualitative and quantitative point of view so that they can take measures towards the control minimization of the consequences of risk. So these classes will be about measuring risk, analyzing risk in investment projects. So the outline of the class is organized as follows. First of all, we'll have an introduction on risk analysis in investment projects. Then we'll look at concepts of risk. So we'll see that we can intend risk from different perspectives, and we can have different meanings for the word risk. Then we'll particularly focus on what we define as project risks, that are the typical risks that I find in investment projects. Then we'll look at qualitative risk assessment, and we'll see that risk assessment can be qualitative or quantitative, so it can be based on the judgment of experts, so in this case it's a qualitative judgment, or can be based on quantitative measures of risk. And in fact, the last topic that we'll look at in this class is quantitative measures of risk, main types and general comments. So here we will introduce the quantitative approach to risk, and we will briefly discuss the different types of risk indicators that we can find in project analysis with some general comments, and then the details of each type of the risk indicators will then be analyzed in the next class. So let's start from the introduction. So a general definition of risk analysis is dealing with uncertainty in project analysis. So the idea is that project outcomes are subject to uncertainty because you are making projections about the future, and the future by definition is uncertain. And however, risk factors can be isolated, quantified, and analyzed. So even though we know that when investing in a project there is some risk, we can have a better grasp of the amount and nature of risk if we try to analyze it in a deeper way. And this allows us to make better prediction of a project expected performance. So we know that a project won't have just one possible performance, but through risk analysis we'll understand that expected performance is just one of the possible outcomes, whereas a project can have different possible outcomes, and if we are able to do that, can be have a precise distribution, probability distribution that could be identified. So we'll analyze what are the tools that can be usefully applied to project analysis to identify different categories of risk, quantify them, and analyze the impact that these risks can have on final project outcomes. So before doing that, the next step is to define the risk, and so to look at the different concepts of risk. So here we can see that we have at least 4 different concepts of risk. First of all, we can intend the risk as a chance of ruin. In this case, we intend the possibility that a catastrophic event in the economic, political, and social environment determines the total collapse of the project. So something happens, the so-called black swan, so something that arises suddenly without possibility of fully predicting it, and determine the unsustainability of the project. So from that moment on, the project will collapse and could not be realized. So this is the worst type of risk because it means abandoning the project and losing the work capital that is invested in the project. A second, milder definition of risk is possibility of loss. So this means that there is some possibility that the project will not perform as expected, so the investors will incur in some losses. There could be a partial loss of the capital invested, or simply can happen that the rates of return of the project will be lower than expected. So, for example, they could decrease below the cutoff rate that had been individuated at the moment of the decision. So, in the end, the project could have rate of return that are lower than the minimum acceptable rate of return that I had fixed for this project. Then risk can be intended as variability of return. So, as I was mentioning before, a project has not only one possible outcome, but is a wide range of possible outcomes. And each of the possible outcome can happen with some given probability, if we know the probability, depending on a series of conditions concerning the market, the general environment, so that in the end, when we are examining a project, we have generally one expected outcome, so one expected NPV, for example, one expected IRR. But then around this expected value, we have some kind of distribution of possible different outcomes that will happen with some kind of probability, depending on the occurrence of the certain conditions in the relevant environment. And finally, with a more general view, we can intend risk as a probability of an undesirable outcome. So clearly, as we say, given the variability of return, it can happen that the final return of a project is at a level that is undesirable. So the fact that there is a probability that this happens is per se a risk, and so the risk can be defined in more general terms as probability of an undesirable outcome. So given this general definition of risk, now let's see how they apply to the specific the specific participants of in the project. So the risk can be different, clearly, depending on the type of investment made or the type of position held by each of the participants. For an equity investor, the risk is related to the loss of committed capital or results that do not meet the criteria. So when I am a shareholder, as I know, I invest in a project for some expectation of return. As we know, there is no contractually determined payoff, so there is no obligation for the firm to remunerate the shareholders. So if the project does not attain expected results, the remuneration of the shareholders could be lower than its expectations. And so this could either reduce the rate of return, but in the most serious case, could bring to a partial or total loss of the committed capital in the case of ruin. So the risk can both concern the return, and in most serious cases, it can also reduce the capital if the company is going to lose money on this project, so that in the end, not only we have a return not in line with the expectation, but we have a negative return that will reduce the committed capital. For a financier, the main risk is the default of the loan. So if the company is not able to serve debt, so in this case, not only it's not able to pay interest, but it's not also able to pay the principal. This can imply a loss of the principal of the bank. That can be a total loss in the case of a default that does not leave anything for the satisfaction of the bank. It can be a partial loss of the principal in the case after the default there is a possibility of recovering at least part of the principal of the debt. Clearly, the eventual guarantor of a project will suffer the risk of receiving demands from the creditors. In fact, the guarantor is the ultimate responsible for the repayment of the loan, and if the loan is not paid for default, the creditors will ask the guarantor to be refunded of the loss they suffered because of default. So in the end, the guarantor is the subject that is suffering the consequences of the default. And for the government, also there is an implication, because if the project fails and does not produce the desired outcomes, this means that the government has misallocated public resources, and these public resources are scarce and they have to be allocated in an optimal way in order to guarantee the government objectives. The risk that the project does not reach the desired outcome is clearly a problem, because this means a waste of public resources and a failure, at least a partial failure, in the pursuit of the government objectives related to the intervention the government made in the project. Finally, we can have different determinants of risk. So when we talk of risk, we are talking about different kinds of risk depending on the source of risk. Here, first of all, what we can easily recognize is that typically projections made over a longer period are riskier, simply because projections made over longer periods are more uncertain. Future states are more difficult to be predicted. So the longer the prediction go, the harder it is to make good predictions, so the higher is the risk on the values that are predicted for more distant years. So when we are predicting the cash flow for a project, typically the cash flows that are in the later part of the life of the project are ceteris paribus riskier than the cash flows that have been predicted for the earlier life of the project, for which I have probably a clear vision. Then there is a higher risk when there is a greater variability of the critical variables. So, for example, I could realize my project in an environment that is more volatile, so it's more political uncertainty, more social instability, more rapid economic cycle. So all these conditions clearly are exogenous conditions that impact on the risk of the project, independently from the characteristics of the project, but however are a source of variability of the outcomes of the project itself. And finally, clearly the risk also will depend on the specific characteristics of the project, and so on the fact that the project is about new products, services, and markets. So if I have a project that is related to the commercialization of an existing product for an established market, clearly the level of risk will be lower, because I know the product, the technology is proven, the market is an historical track that I can use in order to project future values. So in this case, typically the risk is much lower. Instead, I have a much higher level of risk when the project entails the development of a new product or new service, and it refers to a market that at the moment does not exist, because in this case I have much more uncertainty about the effectiveness of the new technology that is not proven yet. And moreover, I'm not really sure that there is a real market, or anyhow, if there is a real market, I'm not sure about the size of this market, so there is a higher demand uncertainty. So in the case the project is referred to new product, services, and markets, ceteris paribus, I will have a higher uncertainty and therefore a higher risk than in the case when I have instead an existing product and an established market. So now let's apply these general considerations about the risk and its meaning to analyze more specifically what are project risks. And here we have a list that is clearly not necessarily complete. We could find other types of risk, but that include the most typical risks that I encounter in projects. So first of all, the typical risk for projects is business risk. So business risk means that there is a risk of not attaining the predetermined operational targets in terms of revenues, margins, growth, and so on. So clearly, if I'm not able to reach the operational targets, the outcome of the project will be lower than expected, so I will get undesirable outcomes. And that's why business risk is a typical form of risk affecting a project. Then I have price or inflation risk. It can happen, for example, that inflation is higher in the future than the rate that I predicted. This happens above all if I have a long period of life of the project. So it can happen that in the longer term I'm less able to predict the inflation correctly. And the risk is mainly if this expected price increase or inflation risk affects the cost of the inputs. So it can happen that the cost of one or more inputs increases more than expected. This clearly will have an impact on the margins and therefore on the value of a project as a whole, and will bring to poor results and therefore to undesirable outcomes. Then I have a possible interest rate risk. This happens when the firm is subscribed a loan with a floating rate. Because clearly if the loan is a fixed rate, the interest rate risk is shifted to the bank. But when I'm subscribing a loan with the floating interest rate or I'm issuing a bond with the floating interest rate, clearly I'm assuming the risk of an increase in the interest rate levels. And this, as we know at this point, will affect the cutoff rate because it affects the cost of capital. And again, will bring to undesirable outcomes because will reduce the value creation of the project. Then we have an exchange rate risk. This is a very common risk that is often encountered in the international projects. So it can happen that you invest into a production of products that then will be sold in foreign markets, so that the exchange rate clearly will affect the future revenues of the project. Moreover, it can happen that most of the inputs are imported for a given project, so the price is regulated in foreign currency, and so a depreciation of the local, the domestic currency will increase the cost of the inputs for the project and will decrease the results of the project, again producing an undesirable outcome for the investors. Then there is the typical market risk that is related to the fact that the demand for the product cannot be so high as expected, or simply you have a downturn in demand over time. So at the beginning the demand is in line with your expectation, but then the demand will decrease and therefore the revenues of the later years will be lower than expected. This again will create a problem with the revenues and with the results of the project, and again will generate an undesirable outcome. It can also happen that the quantity that you are able to sell do not change as much as compared to expectation, but that, for example, the price could decrease more than expected over time, so that in the end, again, for the later years, you will have a lower revenues than expected, with again poorer results and lower value of the project. Then you have a technical risk. It can happen that the technology underlying the products or the service that you are selling is performing not as expected. So the problem could have problems with technical performance. You could retire a given product because of a failure in some specific tasks. So this is an additional cost that you had not forecasted at the beginning. And again, this is a factor that can impact on the results of the project and therefore generate an undesirable outcome. And finally, you have a more general risk that is typically source of country risk, that is political risk. So the fact that political instability affects the general conditions under which the project is managed. For example, it can happen that a project is being realized also because we'll receive subsidies by the government, but it can happen that due to a sudden political change in the government, or just to a sudden decision of the existing government, these subsidies are renegotiated and changed over the life of the project, and this clearly has an impact on the financial sustainability of the project, with again the production and desirable outcome for the investors. Okay, so these are the main risks that can affect the results of a project. We have seen that they have different nature, and the sources of risk can be very different. So the risk analysis requires a comprehensive assessment of the different sources of risk and their impact on the performance of the project. And this risk analysis can be realized in two ways that are not necessarily mutually exclusive, but they can be usefully complemented because they provide suggestions and information of different nature. You can, in fact, having a qualitative risk assessment that mainly implies the involvement of experts in giving judgments about the general environment in which you will execute the project. In this case, the output of the qualitative risk assessment is by definition non-quantitative, and is more in the form of opinion or suggestions about the main risks to account for, and for the measures you could take to reduce the risk, or anyhow reduce the impact of eventual risk occurrence on the performance of the project. On the other side, you have quantitative measures of risk that, as we'll see at the end of this class and the next class, will require the calculation of quantitative indicators that will provide specific measures of the risk affecting a project, and of how these risk can affect in the end the expected performance of the project. So let's start from the qualitative measure. In particular, let's look at what we mean for qualitative risk assessment. So qualitative risk assessment is mainly based on expert opinions. So at the moment you are making a decision about a project and you already analyzed the project, you already got quantitative indication about future cash flows and performance indicators, you can ask some experts to give you their opinion about the main risk factors that could affect the quantitative results that you have predicted. As I was saying before, this expert opinion will not be quantifiable in specific measures, but will be very useful and will provide a source of complementary information that you will take into consideration for your final decision. So in other words, it could happen that the quantitative indicators of financial performance provides you with a general positive valuation of the project, but there's aspects could underline that in your analysis you have underestimated some potential risk factors, and that these potential risk factors could be critical for your project, so that in this way you could review your decision and try to understand whether these risk factors are so important to change your final decision. So these expert opinions can concern different aspects of the management of a project. First of all, they can concern the degree of uncertainty in economy, politics, social system and capital markets. So there are different sources that we discussed, the risk that could affect the final outcome of your project. Some of them have to do with the economy as a whole, so on its expected growth, on the sovereign debt, on the future fiscal policies needed for budget reasons and so on. On the politics, and in particular on stability on the political system, the possibility of new election, the potential implication of new election on the project, if the project is sensitive to the eventual presence of different political parties at the government, if there are incentive or subsidies that could be revoked, and so on. On the sustainability of the social system, so if there are inequality in the population that could affect in the end the stability of the general environment and therefore the normal execution of the project. And finally, the capital markets that are clearly a necessary condition for raising finance in that country, and for the cost of capital that you have to pay in order to raise finance in that country. So also capital market stability and capital market conditions are a social risk that you could explore further with the involvement of experts and through the opinions that they will give about these general aspects of the country where you decide to invest. Then they could provide opinions about the economic cycle. So they could, for example, advise you whether there could be future recessions or if you can expect sustained growth in the future year, and if you're in recession, how much this will last, and when the recovery will start, and what is the expected growth rate after recession. So in general, they could forecast the dynamics of the economic cycle that clearly is one of the basic conditions affecting the performance of the project. Then you could have marketing experts that could provide you with their opinion about market risks. So if, for example, the demand could be lower than expected and for which reason, if there are problems with your pricing strategies, if you expect over time a decrease in prices due to competition or obsolescence of your products and so on. So in this case, you are going to involve different categories of experts that are typically marketing experts. Or you could assess the technology risk through the involvement of technological experts that could provide you with information about the current state of the technology, on its expected maturity, on the presence at the moment of alternative solution, or about the introduction of future technology that will displace your product from the market and clearly will make your project not sustainable anymore. So as you can see, qualitative risk assessment can provide you with a lot of useful information about many different aspects of the project you are evaluating that, even though not incorporated into the quantitative model, provide useful insights that then you can consider along with the quantitative measures in the moment you will have to make the final decisions. And they are also important for the identification of the risk factors that then you can try to quantify using quantitative indicator risk that we'll introduce in a moment. So the qualitative risk assessment is an important task that you should perform before making the first decision, and you should perform also before having a more analytic and quantitative assessment of risk, because qualitative risk assessment can identify some risks that after that you can try to quantify using quantitative indicators. So the last topic of this first class is about the quantitative measures of risk, and in particular here we'll introduce the main risk indicators that will then we'll analyze in detail in the next class. So here, therefore, we have a quantitative measure of risk. The first is statistical probability. So the idea, as I was mentioning before, is that the possible outcomes of the project are in general distributed according to a certain range of possible values. So this range could be known or not known. But however, they are distributed according to a certain range. So if you know, or at least you don't know exactly the distribution, but you can imagine or can forecast some kind of probability distribution, then you will be able to draw the probability distribution of all the possible results of the project. And in this way, you could provide some quantitative indicators about the probability that some undesirable outcome happens. Therefore, this can become a very powerful quantitative indicators of risk for a project, but however, under the condition that you are able to determine the general form of the probability distribution, and so you can assume some kind of probability distribution for the given performance indicator of your project. Then you have the standard deviation of the results. So this is a statistical parameter that measures the possible variability of the results of a project with respect to the expected one. So again, you have an expected result, and then you have some kind of volatility of the possible results across these expected results. So this measure can be typically calculated, however, when you already made an assumption about the probability distribution, because it requires to have some kind of formal probability distribution to calculate these synthetic indicators. Then you have the coefficient of variability, that is a measure of relative risk. What does it mean? As you will see in the next class, the coefficient of variability is calculated as a ratio between the standard deviation of a given indicator and the expected value for this indicator. So the fact that you calculate the ratio in this way allows you to standardize the risk indicators, because clearly standard deviation grows typically with the expected value. So by dividing the standard deviation by the expected value, you get a measure of relative risk. So you have a measure on how the future outcomes of the project will vary around the expected value that you have predicted. So say that this measure has the same meaning as standard deviation, but more correctly reflects relative risk, and in particular account the standard deviation per se is not necessarily a good measure of risk, because it's affected by the size of the expected value of the performance indicators that we are considering for risk analysis. Then we have an interesting and needed indicators for risk analysis, that is break-even analysis. So what is break-even analysis? Break-even analysis is an analysis that allows you to identify the conditions under which the project is a positive profit or positive value. So in particular, just to make an example, the typical problem when you analyze a project is, what is the minimum quantity of the products that I have to sell in order to make a profit? So the risk in this case is the fact that you can sell an insufficient quantity of a product and therefore having a loss. So the question is, I want to start a new business, I have a new project. What is the minimum quantity of products that I have to sell each year not to have a loss? So what is the minimum quantity of products that I have to sell in order to have a positive profit and not to incur in financial losses. So this is exactly what break-even analysis does. It typically looks at profits. It considers revenues, variable costs, and fixed costs, and consider what is the minimum amount of product that you have to sell in order to cover the fixed costs and in order not to incur in a loss. Then you have the payback period. So the payback period is an indicator that we already studied, so it's not a new indicator. We have seen that there is a static version and dynamic version of payback period. In the dynamic version, the cash flows are discounted, whereas in the static version, the cash flows are not discounted. And we have already remarked that the payback period is an indicator of risk because it signals the time when the cash flows of a project recover the initial investment. And what we have said before is that projections that are more distant in time are riskier. So the payback period, saying what is the time you recover initial investment, is a measure of risk because a shorter payback period says that the project is less affected by more distant projections. So if payback period is in 2-3 years, this means that you have recovered the initial capital after 3 years. And even though the life of the project is 10 years, you won't be so much affected by what will happen with the projection at year 8, 9, or 10 of the life of the project are by definition the more uncertain and the riskier. So in this sense, the payback period is an indicator of risk because signals that the project is less sensitive to the projection that are made on a longer time and so that are more risky. Finally, the last indicators at which we'll look in the next class is sensitivity analysis. So sensitivity analysis is an analysis that you perform by changing one or more critical assumptions in the projects and saying how the final outcome changes. So for example, you could have a critical assumption about the cost of capital, a critical assumption about the growth rate, a critical assumption about the operating margin, and you could look at how changing according to some predicted rule this assumption, the NPV of the project changes. So in other words, you could ask if the cost of capital was 1% or 2% higher than predicted, would the NPV still be positive and how would it change? Or if the growth rate of the revenues is 2% instead of 3%, does it affect the NPV and how? Or if the inflation rate is higher than expected, how this affect the NPV, the IRR, or any other performance indicator, static or dynamic, that is of interest in that moment. So sensitivity analysis is very useful because these assumptions are uncertain, and these assumptions can critically change the final performance indicators. It allows you to determine how specific assumptions change the results and allows you to identify those assumptions that are more critical because more uncertain and because they have a greater impact on the final performance of the project. So all these indicators will be analyzed in detail in the next classes so that we look at how each of them is implemented and the specific characteristics, the formulas, and how they are used and interpreted within the broader context of risk analysis. So with that, this class is finished, and I thank you for your attention. And I remind as usual that additional materials on this class are available on the course website. Thank you.